Lots of investors are chasing dividends, payments made by a corporation to its shareholders, usually in cash and usually as a distribution of profits. You can find information on the amount of a dividend that is paid on the investor relations website of a company, more specifically on the dividend history page. For example, for Microsoft, in fiscal year 25, the dividend was $3.32. In order to put that dividend per share into perspective, you can compare it to earnings per share. At the bottom of the Microsoft income statement is the net income of $101.8 billion, and below that is the translation to earnings per share, $13.70 per share. You can now calculate the dividend payout ratio by taking the dividend per share and dividing it by the earnings per share, $3.32, divided by $13.70 is 24%. The dividend payout ratio is the percentage of earnings paid out to shareholders as a dividend. To pay out or not to pay out, that is the question. So if at Microsoft 76% of earnings is not paid out as a dividend, does that mean that all of this is retained within the company? Not necessarily. The Microsoft balance sheet provides us the information to answer that question. Retained earnings balance at the beginning of the year, add the net income of $101.8 billion that we found on the income statement, minus dividends paid, minus the impact of share buybacks on retained earnings, and you get retained earnings balance at the end of the year. Share buybacks are very common for companies listed on the stock market, and compared to dividends that are expected to go up over time, share buybacks are a flexible way for companies to reward shareholders. Let's think through the possible ranges of outcomes for the dividend payout ratio. For Microsoft as an example, the dividend per share amount is a positive number, and the earnings per share amount is a positive number that is larger. As a result, 24% dividend payout ratio for Microsoft nicely falls into the regular range. A dividend payout ratio of 0% means that no dividend is paid out. A lot of companies in the embryonic or growth stage of their business cycle, but also mature companies that do a lot of acquisitions, are at this 0% level. A dividend payout ratio of 100% means that all earnings are paid out as dividends. I don't know any companies that are consistently at that 100% level, but real estate companies tend to get close to that as they pass through the vast majority of their earnings as dividends to shareholders. What about the outliers? Let's look closely at the dividend payout ratio calculation. Dividends per share have to be equal to or greater than 0. Earnings per share can be positive, 0, or negative. If earnings per share are negative, then the outcome of the dividend payout ratio calculation is not meaningful. If dividends are bigger than earnings, then the dividend payout ratio is higher than 100%. This tends to be an unusual situation, for example, when a company has non-recurring special items in their income statement, such as goodwill impairment, that brought down the level of net income. That is why some companies talk about the dividend payout ratio as a percentage of adjusted earnings per share, excluding special items. If a company has a dividend payout ratio that is consistently above 100%, you need to start worrying whether that level of dividend payout is sustainable.